What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we are breaking down how these meme stock crazes happen here by covering what it means to short a stock. So if you're excited for today's video or just curious to know what Fridge Financials is teaching today, feel free to like the video as always, subscribe to the channel, and turn on those bell notifications for all future uploads. So we're going to break down how the basics of shorting a stock works. There's a cool little visual here, which I was not going to be able to make, so I wanted to use their visual because it makes a lot of sense. And we're going to talk about how this essentially works. And then when does it go sideways to get those meme stock rallies that you see, like Open Door, like Kohl's, like GoPro, Krispy Kreme, Rocket Mortgage, all those different things, or Rocket companies, I should say. All those companies have these kind of lift-off periods of like 15, 20, 30%. Why? So basically, the idea behind it is that shorting a stock means that you're betting the stock will go down in price. It's the opposite of buying and hoping it goes up. And this right here is a nice little visual that helps to verify how it basically works. So basically, you're going to have a short seller here, for example, who bets that a stock's going to go down here. He'll go to the broker and he's going to say, hey, can I borrow 10 shares of this stock? Whatever the case is. The broker says, yeah, of course, you can borrow 10 shares of the stock here. The short seller then will go and sell those 10 shares for, say, $500 on the market. So maybe each share is worth $50. They'll go out and they'll sell each of those 10 shares on the market for $50. But what they're hoping for to happen is they're hoping that the stock price goes down. They see the stock is overvalued. They see that the financials are awful. They see all these different things that line up that point to a stock being worth a lot less. So they're hoping that the stock is going to lose value. Now, let's say that the stock does, in fact, lose value. Let's say that the stock was trading at $50 per share here. Then it goes down to $40 per share. So you're down about $10 per share in this case. So short seller is then going to buy those shares back for a cheaper price. So he sold them for $500 on the market. Then he goes back in later on and he buys the same number of shares, the 10 shares, but he buys these 10 shares at a cheaper price. Remember, he sold them for $500, so he pocketed $500. He buys the shares back for $400. And why does he buy the shares back? Well, what he does is he then is allowed to go to the broker and say, here are your 10 shares back. I still have them. Here you go. And he gets to pocket the $100 difference. So that is essentially what happens on the market. Now, there's a lot of articles as to why this works again, why you want to do it for it to be speculation, how it works. Kind of just went through an example here, and how the idea works. But there is obviously some risk to shorting a stock here. There's a lot of problems you can have with shorting a stock here. And so what we're going to be looking at is how shorting a stock basically works. Well, first of all, you do need to have a margin account in this case. So make sure you do, in fact, have a margin account. There is interest fees or borrow fees because obviously you're borrowing something. Just like you borrow a loan, you will be paying a fee on it as well. Things to keep in mind about. And there's other things like margin calls and stuff like that. But what could happen is if you take a look back at this chart here, what happens, and this could go against you. Because again, you're hoping to buy the shares back at a cheaper price. But what happens if it goes the opposite way? What happens if there's some catalyst that comes out, you're shorting the stock, there's one catalyst that comes out or a couple catalysts that comes out, or maybe just a bunch of money flows in and people buy the stock up and the price goes up instead of going down. So what happens? So what you'll say here is, let's say that instead of the stock loses value, say the stock gains value. Say these 10 shares, say the stock goes from $50 a share, say it goes up to, say, $60 a share. It went up $10 instead of going down $10. Well, you still have to basically cover your shares at some point here. And if it goes up to $60 here, you have to buy back the shares at a higher price. So then you'd actually lose $100 instead. And the way that a short squeeze happens is that what will happen is that, say the price goes higher, this short seller has to cover by buying the shares back to give back to the broker, because again, it's a loan, and he buys at a higher price. Well, that's going to push the stock even higher. Then somebody else who's shorting it also has to cover and buy at a higher price, which pushes it even higher. So you have a bunch of short sellers here that are all buying back at higher prices. And what is that going to do? Well, it's going to shoot the stock price even higher. And then it has all these short sellers start to panic. There's fear, and that's where you get the short squeeze. It's a very interesting thing to watch. Not common, obviously, in the market, but it is a possibility. So, for example, if you take a look at my Webull account here that we're looking at, just kind of give you some examples here. Kohl's was a bad example because the short squeeze happened here in the pre-market. So Kohl's is one where everyone was talking about the pre-market short squeeze here that was happening. There wasn't a lot of movement. Oh, it was back here. Whoop. Sorry, almost a little too far back. So Kohl's had a huge movement way too fast. Okay, and there wasn't a lot of volume in the pre-market. It has to happen, honestly, does have to happen during trading hours when there's a lot of volume here. Because if you're doing it pre-market, a short squeeze happening pre-market probably won't do much because there's not a lot of volume. A little bit of money can push a stock in a big way in this case here, right? That's kind of the focus point that we're talking about in this case. So you had a little bit of a push up into the market over about 100% gains here, which is absolutely wild that you saw from Kohl's, but there wasn't a lot of volume pre-market here. Then the stock gets suspended. Now, the suspension is not because people are greedy or because the market hates us. The stock suspension is built into the NASDAQ. It's built into indices, into stocks. It's built in as protection. Okay, I talked about that in a previous video with Open Door. Very similar idea. Here is what happened. So it got suspended, people panicked, and then the stock price came right back down. So that was Kohl's, for example. Another one that we saw was Krispy Kreme. Krispy Kreme actually had a crazy rally here, as you will see, and now it's kind of done basically nothing. But at least here you get that volume here that you're looking at. But again, it was only short-lived, as we know. Open Door was the one where there was a lot of hype around it and there was a lot of volume. And I made a previous video on Open Door as to what is something to keep in mind about. And the thing to keep in mind about is obviously your volume. And so when the volume dies off, that's when you're going to see the stock price come back down to reality on a short squeeze. Because again, you need the volume to push the stock higher, because if the stock pushes higher, shorts have to cover. They have to close their positions to give their shares back to the broker that they borrowed from. And in order to cover, they have to cover by buying it in higher, which then triggers it to push even higher and higher and higher. But once you see this volume come back down here, the short squeeze is over. I don't see this squeeze happening again. You know, it's up 6% right now, but obviously, who knows? You can get rug pulled very, very quick, as we know. But you can see this nice big rally here because, again, the short sellers are like, oh, crap, now it's at $1.60. Oh, well, I shorted it and I bought it for $1. I borrowed my shares for $1. Oh, I had to close it at $1.60. Oh, well, I got covered for a loss. Then that pushed it higher. And then Steve, who works at another account or who's shorting the stock as well, is like, oh, crap, now it's even higher at 1.8. I got to cover my shares and close it out for a loss. Then they close it out. And then it just keeps going and going and going and going. It's a chain reaction. It's honestly, it's like a big spiral that like unravels. And that's where the short squeezes come into play, because it's a lot of short sellers who are panic selling or panic buying back their shares at a loss, which pushes the price even higher because they're buying it at higher prices here. And that's what causes these short squeezes to happen. Now, if you take a look at short interest data, it is important to look at and to keep in mind about how it works here. So the short interest flow basically talks about how much of the shares are shorted. So for Krispy Kreme, about 33% of shares are shorted at this current moment in time. And the short interest ratio is 6 days to cover. The longer the amount of days it is to cover, the longer the squeeze can go on for. Okay, because it would take 6 full days for all of the shares to be basically, closed out, for those positions to be closed out. It'll take 6 days for the short sellers to offload all their shares. 6 full days gives the Krispy Kreme a 6-day running period potential in a short squeeze, which that's where a lot of money comes into play. Because if it's going to take that long to cover, it's going to keep pushing it higher and higher and higher. Then it hits Reddit. Then it hits Wall Street bets. Then it hits social media. People start pumping it higher. Then it unravels to a bigger short squeeze that we look at here. So Krispy Kreme was one that was, again, one of those meme stocks that we look at. But the problem is that we look at shorts that are available, or short shares that are available here. If there's no short shares available, that means it's maxed out shorted to the biggest potential that you have. You have the max number of shares that are shorted in the for the stock. In this case, there's still plenty of shares that you could short here. So that's why a short squeeze really didn't happen for long, because there's so many shares available to still short. I can come in and short it for another 500,000 shares if I wanted to, and, go from there. I still have the availability to do it. When there's 0 shares left to short, that means it's max shorting, which is a problem. That's what people start to look into, say, oh, wow, look at the max pain is going to happen, because if it starts to unravel, all those shares have to get liquidated somehow. It's going to push it higher and that kind of stuff there. There's also extreme fees that come with it as well. If the short shares available is 0, that's either because they're out of shares, and also if you do want to short it, the fees are going to be absolutely ridiculous. Like, imagine paying like $100 to short like a $1 stock or whatever. I don't know what the actual ones are. I don't actually short stocks in my personal experience, but just some knowledge behind it as to how it works. GoPro was another one, but again, they only have about 10% short interest percent that's being shorted right now. As you'll see, it did hit 0 a little while, but then there are some shares that are coming back up onto the market. And if we take a look at GoPro, you can see that GoPro had a little bit of that nice run up here. And again, it fizzled out pretty quickly, as you'll see. Look at that huge rally up. And again, seeing this rally happening still in the market day means that like it's not just like a pre-market move only, but then you got a huge move pre-market, and then people took profits and sold it off. This is always the big problem with shorting stocks here, or with betting on short squeezes. This is always the problem, is because people will take profits. It's not like a gung-ho, we're all in this together, High School Musical kind of idea. It is I'm going to take profits when I want to take profits. If you bought in at $1, you could have liquidated it at $2.40 and over doubled your investment in a matter of a day. Why you wouldn't do that, I have no idea. It's not like Kumbaya, GameStop, AMC, where it was like power to the institutions. Let's push against them. Let's be rebellious and liquidate all their holdings back in 2021. Now it's kind of more of like I'm taking profits when I want to take my profits here. So GoPro was another one that was shorted. But again, it came back down to reality, as we know. Open Door does have some shares available, but believe it or not, they actually only have 20% short interest. Still a very high number, but the days to cover is relatively short at 1.5 days, which means that they can close their positions really quick and cover in only 1.5 days is all it takes. That's not a long period of time. GoPro was 2 days, same thing, not really a lot. But Krispy Kreme having that 6 days to cover means it takes a little bit longer, right? So Open Door, again, same thing. And the last one that we saw that was Kohl's. Kohl's actually has a lot of short interest flow volume here. So 45% is being shorted of the available shares for Kohl's. And it's also going to take almost 6.5 days to cover. So it'll take a long time to unravel it. But the problem is, again, is that there still is a lot of shares that you can short, because there's still a lot of shares available. 1 million shares are available as of 7 minutes ago. So people can still short the stock to the high heavens if they would want to. And we can take a look at Kohl's and see that, again, it had that nice rally pre-market. Then it kind of came back down. And now, again, we're just kind of trading normally. Again, there was a nice rally today. Is this going to be possible to stay there for a long period of time? Probably not. Again, short squeezes don't last a long period of time, except for the GameStop and AMC problem. I think some people look back and they saw how much profit people missed out on. So now people are being selfish, which they should, and are taking their profits whenever they can. So maybe if people bought in and got that 10% return on Kohl's yesterday, I would take that 10% out. If I made 10% on my investment, take it out, wait for another dip, and get back in again. So that is basically the idea as to how shorting a stock works. It's a very powerful tool that a lot of people have used, but this is the risk as to where the short squeeze happens, right? So if you hope to buy the shares back for a lower price, and it doesn't, and it pumps higher, then you buy in higher, then somebody else buys in higher than you, then another person buys in higher than you to close their shares out and close their positions, or they have a risk of being margin called, which, as we know, margin call means, hey, they're knocking on your door saying, open up, I need my shares back, maybe it's Robinhood or Webull. It's going to force you to liquidate at a higher share price to then get your shares back. And that's when the losses come in. You short the stock, it comes in at a loss, and then the squeeze begins. So that is how basically short selling works here. So if you made it from the video, thank you guys so much for watching. Make sure that you like the video, subscribe to the channel, and turn on the bell notifications for all future uploads. I hope you're making money in the market, whether it's through short selling stocks, buying and holding, options, whatever, Dogecoin, Bitcoin, whatever it is you're making money in. I hope you're being successful in your financial journey. And as always, I will see you in the next video.